all very welcome to Practice News this morning. News for members in practice, all about what's relevant to yourselves. So just to run through what's new this morning, what we're going to be doing in the Republic of Ireland, recent changes to the Companies Act 2014. So there's changes to the SCARP procedures and also the new Corporate Enforcement Authority. I'm just going to be telling you some more stuff about that now in a minute. In the UK, there are big changes coming in the whole filing of financial statements. Essentially, the concept of fillated accounts is going to be gone. Whatever you present to your shareholders, that's what you're going to file. So that's the proposal at the moment. Jeremy's going to talk you through that. Isqm, the deadline is fast approaching. Just going to remind you of that. You have to have in place by 15th of December. Pension schemes, big changes in pension schemes. Essentially, the alternative annual report, which was unaudited, is being abolished. So you need to do something about that. Master trusts, is that the answer? Can be talking a bit more about that now soon. Tax, plenty going on in the world of tax. Gerardo Sullivan is going to give you all the news there. Then I'm going to be talking to our sponsor, AccuVest, about the investment world. And indeed, we're going to touch on the topic of master trusts and the change in the pension scheme world. And we've got a major rundown of what's going on in the world of professional accounting from our professional accounting team. So, Jeremy, we've got a good lineup today, don't we?
We do. We have a packed lineup, and I think something for everyone. And I'm delighted to be joined here today. We actually, I think, have our probably most contributors in one webinar, if I think back to our practice news. So I'm going to quickly introduce everyone. So I'm going to start at the top left-hand corner and work my way around the screen. So firstly, I'm delighted to be joined for a conversation by the professional accounting team. The team, I'm sure you're familiar, is led by Dee Moran. And also we have Lillian Hampel. Lillian is it's your second time on the webinar, Lillian. You may recall Lillian was talking with us about sanctions and anti-money laundering back in our June webinar. And I'm also delighted to be joined by Mike O'Halloran, first time here on Practice News. And Mike, you're very, very welcome. The guys I'm sure you're familiar with in the professional accounting team, they are our institute voice and representatives with many bodies such as the CRO, the Department of Enterprise in the Republic of Ireland and so on. And they also would help out in putting together responses to consultations like with the FRC on changes for financial reporting in different areas. So at 11 o'clock for about 20 minutes, the four of us are going to have a chat about ongoing work in the area. And I'm sure many of you will be particularly interested in the CRO and changes and so on as well. So that's Mike, Lillian and Dee. I'm also delighted to be joined by Garrod. Garrod's second time here. Garrod's the tax manager here with the Institute, and Garrod is going to give us the ROI tax update. Always one of the most popular segments in the show. So Garrod will be tuning in and joining us from Cork today. Great as well to have Leontia with us. Leontia has made a recording of all the changes in the UK tax situation. So of course, we had our mini, or you can call it maxi budget, new UK government, so lots of changes I'm sure you're all familiar with there in the last week or two. But also Leontia in the recording for about 15 minutes at the end of the show at about 11:30 is going to tell us all about her and her team's work with relation to representations with HMRC and so on as well. In case you're not familiar, my name is Jeremy Toomey. I'm Practice Consulting Manager here. I'm sure most of you know myself and Conal, but not. Conal is the Head of Practice Consulting. Conal joining us here from Dublin this morning, and I'm in our Belfast office, so getting a widespread across the island. Conal, click on to the next one if you can. And we're delighted to be joined as well, our final participant here today. And as you mentioned, Conal, AccuVest, we're delighted to have as our sponsors of this webinar series. And AccuVest are actually an investment advisors and so on. And Damien, I'm sure, will give you a bit more of a background to the firm. And we're delighted to be joined by fellow chartered accountant Damien Cooper, about 25 years experience across everything from probably audit right through to actually investment management. So I know Damien and Conal are going to be having a chat about the turbulent investment market we have at the moment. And as you mentioned, Conal, the pensions situation, which is going through a lot of change at the moment. So that's everyone on the show. I'm going to hand back to you to tell us about who's our audience today, Conal.
Okay, well, it won't keep you long. There you go. It's a broad audience, mainly quite senior, mainly FCAs from all over the island. So you're all extremely welcome. That's that. Then our disclaimer, just to remind you, the slides, particularly in this news program, the slides are very high level. They're leaving, every slide is leaving something out, I think it's fair to say. So do not rely on the slides. Go to the source material. We're giving you links there to source material. Go back to that and do your own research. So there you go. So now I'm going to move straight back to yourself, Jeremy, back up to Belfast again.
No break for me. Thanks for that.
No break for you, Jeremy. That was quick.
Keep me working. Listen, Conal, as ever, for the next 10 minutes or so, you and I are going to go through four news items that we think are particular relevance for the small practice community. And today we're going to talk about, and as you outlined in the headlines, the four areas with relation to the Companies Act 2014 and some of the changes and guidance from the Institute there. The next one is about the actual changes and big changes coming in Companies House and filing in the UK. And then we're going to kick into talking about Isqm and finally the pension situation. So I mentioned with relation to the guidance that's been put together, and you can click on again. This is just the front page of the guidance. We're going to give you links to where to find it, as I say here shortly. And this guidance has actually been put together by our professional accounting team, by Dee, Lillian and Mike and the team, and just issued about 3 or 4 weeks ago in early September. And the whole idea here is there's been a lot of changes that have been built into the Companies Act 14 as a result of the two big pieces of legislation to bring, firstly, the SCARP into play in late 21. So from about July until its enactment in December, a lot of changes there, particularly around creditor meetings and so on as well. And also, I think there's been some changes with relation to the actual, the different areas of the committees of inspection and so on as well. Lillian may tell us a little bit more, I think, in our chat at 11 o'clock on this. And also then, of course, the new Corporate Enforcement Authority, the replacement of the ODC, that had to be brought in a special legislation as well to bring it into power, just actually came formally into being and enacted in July of this year. And of course, as well, there's been some of that legislation has led to some changes around share capital, corporate governance, and other miscellaneous amendments. We might talk a little bit more at 11 o'clock with Lillian on that. If you want a link to the guide, it's only about 8 or 9 pages. I definitely recommend it. That link there is in that second paragraph there. So please do check it out. That's as much as I'm going to say on Irish Companies Act 14. But now for our UK audience, or our audience that have UK clients in the Republic of Ireland as well, some big changes with the UK Economic Crime and Corporate Transparency Bill. Very new bill going in front of Parliament as we speak, actually, in London. So Conal, if you can click ahead again. Now, this is actually, and I'm not overstating it here, promises to be one of the biggest shake-ups since the formation of Companies House in the UK about well over 160, 170 years ago. To give you a bit of background as to why this is, I'm sure many of you have heard the push by the UK government over the last year or so with relation to corporate transparency and so on. And a white paper was put out just at about the end of February by the UK government. You can get a link to it there and all different guidance materials at that first link there on the second points. And the whole background here is, to put it straight, the UK government and others were saying that the actual present situation in the UK, that with relation to anti-money laundering and the setup of companies, that there was too many risks with relation to players in money laundering and fraudulently setting up companies, and that this need to be tightened up, and also as well the ongoing returns to Companies House. So there has been some legislation already brought into play, but this new bill aims to give Companies House some real powers and some reality to question, firstly, the company setups and so on, and to ensure that they are being set up legitimately and that they can trace who the directors are and so on, and proposed directors on this. And also as well with relation to constant returns and so on, and checking the integrity of these. But one of the biggest things on this new act that could impact accountants, of course, is with relation to the accounting filing options being lessened for SMEs that Conal mentioned. And Conal, if you can click ahead again to the next actual slide. And some of you that may have been on a webinar we did about 10 days ago now on, it was an Irish Members Guide to UK Accounting, might have seen this or a summary of this as well. But basically, the present regime where you can abridge and fillet and shareholders' financial statements for small and for micro companies and very, very different options, that's going to be really simplified down to just having 2 filing options for small and micro companies. And with this filing option, you will be obliged to actually file the profit and loss and balance sheet for both small and micro companies with Companies House when this new legislation comes into play, if it is presently adopted as it's going through Parliament. And also then you will be obliged to file a director's report for a small company, not for a micro company, but for a small company. And the whole idea behind this is to take away this myriad of actually filleting and abridging. It should make life, I suppose, somewhat easier for accountants preparing these financial statements as options, but also to aid the transparency for stakeholders. So the users of financial statements, be it the shareholders themselves, potential investors, bankers, whatever it may be, and it's going to allow different comparability. I can see the merits in this, but I can see also that it will cause a lot of unease, and I'm sure there'll be a lot of disquiet on this area. What I can say as well is that there's going to be just one set of accounts filed to the different government departments, so tax authorities and HMRC and the Companies House. There'll be extra declarations for dormant companies needed to ensure and to give assurance to Companies House and to any users that they really are dormant companies. And also as well, like we have in the Republic of Ireland and talk of with the CRO, that there is going to be, you need to verify your identity. And I know there's proposals, and we may touch on this, I think, in my chat with Dee and Lillian as well at 11 o'clock, and Mike, with relation to PPS numbers being needed going forward for directors in the Republic of Ireland with the CRO. Same ID, the verified identity of people setting up or actually making filings for companies on the Companies House register, or the same again that it will be made for third-party agents to verify these things. So big changes on the way. If you want to know the next step on this, as I mentioned, this bill is actually just gone in front of Parliament just in the middle of September, about 2 weeks ago. So it's going through its different stages of reading and so on. I would say it's going to take probably into the new year. So probably by next spring that you'll have a final version of this that'll get royal assent and enacted. There'll obviously be a transition period as well. Now, while all of these points I've outlined here are, there's no guarantee that they'll all make it through the Parliament and the reading and be adopted into law. It looks like that this is the thing. So we want to give you a heads up on this. But over the coming weeks and months, as we get a clearer picture, and as of course this moves to the enactments and the law stage, we'll keep you updated. So keep an eye on e-news or different webinars and so on as well. That's as much as I'm going to say on that one, Conal. The next one, and my third segment here today, is audit. And audit, the big thing here at the moment, and I'm sure many of you were on our webinar on Wednesday morning, is Isqm. It's the big game in town this autumn. And for some people who are maybe non-auditors and not familiar and want to know, what is Isqm about? This is the new international quality management standards for any firm that's engaged in audit or assurance services. It's actually globally, there's international standards, and then UK and Irish that have been brought in by the FRC and IASA to match these requirements. The big thing is just over 70 days to go that you have to put in place as any size of auditor, sole practitioner up to the biggest of big companies, design, implement and begin to operate a new system of quality management by 15 December 22. Now, the bad news is that if you're hoping that there will be simply a template like the old ISQC1 in this area, and that you can just put your name in it as a small practitioner and that's your work done, not quite going to be that approach. You will need to put some work in because it's all about tailoring this new quality management system to your needs, and particularly around the risk assessment area. But there's good news here in that we have guidance and assistance at hand if you're starting out on this. So the first thing here is to check out our Institute web pages. We have 2 links there. They give you a quick overview with relation on the PDF, their documents, as to what Isqm is about, access to the different versions, UK or Ireland, or the international versions, and also some very useful guidance documents as well by the IAASB. Now, IASA as well have been putting out these 3 or 4 minute what we'll call videos on their YouTube channel. There's about 5 of them there now explaining Isqm1, Isqm2 and ISA 220, which make up this whole new Isqm quality approach. So if you want a quick overview and have about 20 minutes, check out those 5 videos and that'll be a good start for you. Now, as I mentioned, Conal and myself did a webinar and hosted a webinar on this just on Wednesday morning, very well attended. We hope for those who are joining us here this morning as well that you found it useful. And also as well, part of that webinar and part of our assistance here to firms is that we and my colleague Michael McAllister and Conal and myself have been working on developing an Isqm toolkit. This Isqm toolkit is to help you to get through the key steps with relation to Isqm. So to set out your objectives and your quality objectives, there'll be around 6-8 areas and the old components of your system of quality management. And then to document your own tailored risk assessment, we have suggested examples that will help you on this, and also then the remediation of the risks and the follow-up and monitoring that's needed in this. So I think this will help any practice to actually go a long way to tailoring and the work that's necessary to get the system in place of quality management by the 15th of December. If you want to learn more about this workbook, you can email us at Practice Members. Conal, I understand it's going to be launched in the coming days, early next week?
Imminently, yes, imminently. It just needs to
and of course, polishing. I think we probably will have other webinars as well as we go into the later autumn period and into the early winter as well about remediation. But we'll keep you posted by email on that as well. So listen, guys, wherever you are on the Isqm journey, there's help at hand for you. And that's my 3 segments. But Conal, I'm going to hand you over and you're going to talk to us about that pensions area and big changes there.
Yes, so about the pensions area in the Republic of Ireland, the big news is that there were derogations for smaller pension schemes, and smaller pension schemes are really pretty meaty, to be honest with you. There were 100 members and less, which is, that's quite a big scheme, who could prepare an alternative annual report, which was unaudited. So that was the previous requirements. That there's been an EU directive which has required us to put in place regulations, which have been put in place in 2021, which have changed the landscape. Essentially, as we focus on our piece here, the auditing and reporting piece, pension schemes, including one-member pension schemes established after 2021, are now required to produce an annual report and audited accounts for scheme ending on or after 31 July 2022. I think that actually includes pension schemes, the one-member pension schemes as well in that. It's slightly nuanced there, but effectively that's what's going to happen. So as you can see, the concept of the reporting light is really going to be removed for pension schemes. There are transitional arrangements in place for schemes established prior to 2021, but there's also the Pensions Authority has recently put out the news that if a pension scheme makes a formal commitment before 1st of January 23, that they're going to wind up the scheme by 31 December 2023, and they actually do that, that they don't have to have that final set of accounts audited, so that they can continue with the previous reporting arrangements. I'm going to talk more to Damien Cooper from Accuvest about this, because that's an area that they're involved. I mean, the most obvious thing that pension schemes are doing at the moment is to incorporate themselves into master trusts, which will enable them. I mean, that's really what the intention is. That small pension schemes shouldn't be burdened with all of this compliance, which I'm only mentioning part of. The idea is that they should actually form into master trusts, but there's obviously a right way and a wrong way of doing that, and we're going to talk about that later. So that's really where that is at the moment. So I'll pass on back to yourself, Jeremy.
Back to me. Thanks for that update. So that's been your 4 pieces of key news. So hopefully that'll be of use to. I'm sure it'll touch upon all of you in some way or other. Those 4 pieces. So look, as I mentioned, one of the most popular segments always of Practice News is our Republic of Ireland tax updates. And for the second time, I'm delighted to welcome back Gearóid O'Sullivan. Gearóid, hopefully you can hear and see me. And Gearóid, I know you're joining us again from Cork this morning, so we're definitely getting across the island. Gearóid, I know for you and your team, it's been a very busy couple of weeks. The budget, there just last Tuesday week, it was one of the more, I suppose, bigger budgets for the last couple of years. A lot of different initiatives in these very challenging times. Without further ado, I'm going to hand over to you because I know you've lots of other things to tell us about revenue interactions in the last month or so as well. So, Gearóid, the floor is yours.
Thanks, Jeremy. Good to be here and good to be sharing the latest updates from the tax department. So, as you mentioned, Jeremy, it's been a big few weeks, but particularly a big week and a half now with budget passing last week. And yeah, I suppose a lot of expenditures in this year's budget, not an awful lot, I suppose, tax technical updates, but we'll come to it anyway toward the end of today's update. Just we'll run through some of the highlights. So first on the agenda there, we'll take it in order, is just an update on the non-resident landlords. So look, this has been, I know this has been going on for a while now, in terms of the issues with withholding tax and the filing of returns and workarounds under Form 11. So Revenue have released an updated manual. So TDM part 380104F, and they have finally agreed to a workaround. Now it's going to require engagement with my inquiries. So what they're saying is, in exceptional circumstances where the return has been completed by or for a non-resident who does not have a collection agent acting on his or her behalf, and no tax was withheld by the tenant. So what is needed to be done is, in advance of filing your Form 11 for 2021, you need to contact Revenue via my inquiries to notify them that the non-resident is aware of the obligation for tax to be withheld, and that arrangements will be put in place to comply with Section 1041, so 1041. And then you tick the box, even though the tenant has not withheld any tax, and you make no entry in the amount of tax withheld. So not even zero, no entry. If you put in zero, it won't process. Now, this is a workaround to enable filing of 2021 Form 11s. Now, it is contingent on landlord putting in arrangements in place for going forward. So obviously, look, if arrangements haven't been put in place by October 21, that means 2022 is going to be in a tricky position. Of course, we'd have to engage with Revenue. That comes up in 2023 when we're filing 2022 returns. But essentially, just get the arrangements in place as quickly as you can. Particularly, you'll have to now because you've agreed it to Revenue. But that's where where we've got with the workaround. So, it's obviously going to, it leaves still a good bit of compliance obligations on us as tax filers on behalf of our clients, but this is what Revenue have agreed to. So I suppose it's sort of a middle ground. Look, hopefully the Department of Finance will kind of update the legislation in due course, but look, we can only work based on what the legislation is, and the requirement to withhold tax is a requirement under law. So just have to communicate that with our clients as soon as possible and as early as we can, especially as going forward now. So that brings me on to my inquiries, and again, to reiterate the exceptional contacts facility and that option. Now, I know we mentioned this the last practice news, and again, I want to reiterate it here because look, my inquiries, as we know, is service levels issues are being encountered by members certainly across the country, although we do hear that service levels are improving. But if you find yourself in a scenario where a query has been going on beyond the standard 20-25 days, you can use the exceptional contact facility, and it's an email facility, and you should get a good swift response from the exceptional contact facility. We've members who have used it who've reported very positively about quick and swift resolutions of queries that may have been going on for an unacceptable length of time. And Revenue have acknowledged, look, sometimes like in any organization, sometimes some inquiries may not be dealt with the best. Now, the majority are dealt with with due skill and care. But if in those scenarios where you find a query has dragged on, use the exceptional contact facility, and Revenue have informed us to share this with you, to go to this facility when you need it. So next, just to move on to phased payment arrangements. So just don't want to speak too much about these. We're all well aware now of that warehousing, phased payment arrangements, and hopefully for most of your clients, if they haven't received letters yet about putting in phased payment arrangements, they should be receiving them certainly this month. So for the standard PPA, it would require a down payment of 25% and a duration of up to 36 months. We've been told that applications for phased payment arrangements will process pretty quickly. So hopefully that will be your experience when you're engaging with Revenue. For non-standard PPAs, so this is where this is where perhaps the down payment just isn't sufficient, or you might need maybe a different payment arrangement. The taxpayer, you will need to outline a business case for why a non-standard PPA is required, and as part of casework or review of the application, additional support and documentation may be requested. So the extent that if will be dependent on the specific circumstances, but could include bank statements, lists of assets, and any encumbrances on them, cash flow projections, up-to-date management accounts, things like this. Revenue are open to engaging with taxpayers who are in the debt warehouse and who require non-standard phase payment arrangements. We are looking at the scenario. We have engaged with revenue on what's to be done where there's not tax clearance in place. So if there's not tax clearance in place and you're looking for a PPA, the down payment is as high as 40%. Now, revenue have said, much like the non-standard PPAs, they would engage in a case-by-case basis. But I guess the message we're trying to get out there is, for debt warehousing and phase payment arrangements, engage with revenue as soon as possible. If you have a client that is going to struggle to meet we'll call them the basic requirements, well then engage with your caseworker. And as I say, revenue want to engage with taxpayers on this. And just an extra thing I'm going to mention on debt warehousing is level 1 compliance intervention letters are issuing to taxpayers who participated in the debt warehousing scheme, as well as taxpayers who were eligible to participate, who may not have participated but were eligible. And revenue are offering an opportunity to self-review returns and make an unprompted qualifying disclosure of any previously undeclared liabilities which would have been eligible for warehousing in period 1. So the benefits of the debt warehousing scheme will be available to taxpayers in respect of additional eligible tax liabilities, provided the unprompted qualifying disclosure is submitted by 31 January 2023. So this is just revenue have identified maybe a certain cohort of taxpayers who I suppose may have been open to the benefit, and it just means that if you say are reviewing your tax affairs and you're looking back over a period that was covered by period 1, and you come across, you discover that, look, there was a tax liability, an additional tax liability that, and that should have been paid. If you make the unprompted qualifying disclosure, you could get the benefits of the debt warehousing scheme. So just something to keep in mind if you are doing a review for your clients and something comes up, that there are opportunities there to avail of debt warehousing. So just to move on there now to PSWT, and just want to mention that the work is ongoing here. We're continuing to engage with revenue to find a solution. We're hoping to engage with RLS to, have some sort of discussion and make proposals in terms of, some suitable work around here or suitable options. But it's just things haven't progressed as quickly as we'd like with it. So I don't have a solution yet to bring to you, but just to mention that we are continuing to engage. We have made a submission to revenue on it, and look, as I said, just want to flag that it is ongoing, because I know this is a potential issue for many people, advising doctors in particular who are encountering issues allocating PSWT when in the context of the general medical service contracts. So again, just to say, we are continuing to engage revenue, and in conjunction with the other representative bodies as well. There's quite a bit of work going on in the background, so we will keep you updated on that. Next, just a reminder on updating bank details in the context of the KBC Ulster Bank market exit. So we're just mindful of the disruption that may arise for taxpayers and us as agents, as Ulster Bank and KBC exit the Irish banking market. So revenue have confirmed that where taxpayers have previously, or agents or taxpayers have set up RDIs for their clients using Ulster Bank and/or KBC bank accounts, a change of bank details on ROS will then in turn update the RDIs. So that should hopefully make it a bit, I suppose, cover off a bit of risk in terms of managing the process of the Ulster Bank KBC exit. If previously, if the RDI wasn't updated, it could lead to or to an instance where you haven't filed a full tax return, basically, because if you don't make your payment at the time of filing your tax return, that doesn't count, as you know, as a complete tax return. So it's really important just to make sure for all your clients, just have a quick look, check, are they Ulster Bank, are they KBC, and am I still using an Ulster Bank KBC account? If I am, ensure that it's updated in advance of filing your tax return, and that's vital. But as I say, this update by revenue, whereby any change should filter through to the RDI, should hopefully make life a bit easier for all of us as we're entering into the heaviest part of the income tax filing season. So I'll come back to budget 2023 to near the end, as I said. So let me just give you a quick update on LPT. So again, in the context of filing tax returns, Revenue have reported significant compliance rates for LPT for 2022, with 91% returns compliance to date and an estimated 96% payment compliance for some 2 million properties. So something on the valuation date. The valuation date of 1 November 2021 now applies to all properties. So a notional valuation at that date is required for new properties not existing at that date. Revenue are aware that this may cause some confusion for taxpayers. So Revenue have advised that local authority factors for 2023 should be available after October. Revenue want to also note that a late filing surcharge in respect of income tax, corporation tax and capital gain tax can be applied where a liable person is not fully compliant with their LPT obligations. Revenue have indicated that there are potentially 30,000 Form 11s exposed to an LPT surcharge. Customer service notices should have commenced issuing the end of September, but if not already, they should be issuing, certainly at the moment. Presently, they should be getting out to your clients. So just to keep in mind that LPT compliance is an important part of the income tax compliance process, and it could result in unnecessary surcharges. So what Revenue have advised is if you could sort out your LPT in advance of filing a tax return, rather than filing a tax return then settling LPT, get the LPT sorted first. It'll just make life easier, especially, look, there's not going to be time for back and forth over the next few weeks. So when you're doing your income tax returns for your clients, just, double check your LPT, make sure that's all in order before going on to file your actual income tax return. Next here we have the debt management services. So just a quick note to say that Revenue has returned to standard debt collection for all customers, including business and personal division customers, or taxpayers. Revenue likes to call them customers, but obviously that's just our taxpayers. So any customer who's lost benefits of the warehouse, if warehousing has been revoked as part of the recent compliance program, all that debt will just be managed now through the standard debt collection process and will be subject to standard interest charges. But just to note that debt management services have recommenced and are back to usual service. So the last point here before we give the quick roundup of budget 2023 is on share-based remuneration compliance program. So this got mentioned as well in the budget. Revenue have identified a significant gap in terms of what's been reported by employers in terms of share schemes and share awards versus what's been returned through income tax from the various channels. Not alone in terms of RTSO tax when we're looking at things like share option schemes, but also in terms of dividend withholding tax. They haven't seen a significant increase in that because share options have been exercised, so therefore people are wanting shares, and as the Revenue expecting certainly a bit more dividend withholding tax there. Capital gains tax, they're not seeing an increase there. So Revenue have identified a significant gap there. The numbers were mentioned, as I say, as part of the budget speech. So we are looking at, the Commissioner of Taxation mentioned it, we're about to make a submission on streamlining the reporting process for share-based remuneration. So it should all go through payroll for relevant employees. But for now, we are where we are. The rules haven't changed. And there's still quite a significant education gap in terms of the particular share scheme that has been awarded and the reporting obligations of those particular awards, and whether it's on the employer or the employee, etc. So what we would say is that for clients who have received share awards, Revenue are coming after it. So again, just to follow up with clients, if you have particularly in your SME sector where they mightn't have the same level of finance function in terms of the same level of tax function that some of the bigger companies would have. Maybe that, again, that education gap is maybe a bit more of a pertinent risk. So just keep in mind, where you have clients who are interested in share-based remuneration, revenue are really looking at this now and over the next couple of months, and they have identified a big gap in terms of potential revenue it has potentially been lost to the exchequer. So they're going to come knocking, as we know. So just for the last few minutes here, I will just give a quick roundup of some of the highlights of Budget 2023. So for people who followed the budget on the day, you'll note that it really has been a cost of living budget. So I suppose for the third year in a row, it's sort of a crisis budget in that sense. And so from a tax point of view, it's been relatively limited in terms of tax updates. There's quite a lot coming down the tracks in an international tax point of view and things like this. But again, we haven't seen a huge change from a real tax technical perspective. Much of the measures are in the expenditure side, and we all know did quite a significant package of once-off measures. But just, I suppose, for people on the call here, what would be certainly noteworthy is the increase in the standard rate band from 36,800 to 40,000. That's going to put a nice bit, hopefully, some extra euros back in our pockets. So that's a big increase there. The standard credit, personal tax credits, employee credits, and earned income tax credit will increase from 1,700 to 1,775. With the home carer credit going from 1,600 to 1,700. So the estimated cost of these measures is approximately 1.226 billion on a full year basis. USC rate bands to ensure that the salary of a full-time worker and a minimum wage will remain outside the 4.5% rate of USC. The ceiling of USC, the second USC rate band, will increase from 21,295 to 22,920. So a bit of an increase there. The small benefit exemption is proposed that will increase from 500 to 1,000 euro. So for all of us or for all of you who have your employees, it might be a nice one to keep in mind. Certainly the small benefit exemption there, the one for all vouchers and things like this. I know when I was in receipt of that once upon a time, it's definitely very nice to receive an employee, and it's a nice benefit. It's tax efficient, and especially going up to 1,000 euro, that's quite a way to reward people in a way that's, as I said, tax efficient, and it's good for the economy too, because they have noticed that a lot of that money goes back into the economy. So it's a nice little opportunity there. The new temporary business energy support scheme. So for a lot of us on the call now, this is a bit of a double-edged sword, because we're delighted that this is available to case 1 trades and available to all our clients. But obviously it's not open to case 2 trades, which is should everyone on this call, bar probably a few exceptions depending where you're working, maybe you're in industry and things like that. But for all of us in practice, that is it's an issue. So look, we will continue to we'll discuss this with revenue as it comes up. We'll try and get to the bottom of the reasoning for why they've focused on case 1, but we don't have much details about the TBES at the moment, so the temporary business energy support scheme, beyond what was announced at the budget. So the finance bill will be released in the coming weeks, and we'll have significant opportunity there, or we'll have meaningful opportunity to engage with revenue there following the publication of finance bill to further figure out, I suppose, the nuance of how this will play out in terms of the compliance and maybe, where middle ground needs to be reached with revenue. So we're all, I suppose everyone's aware of the TBES, because I suppose it was the most significant taxation measure introduced that will be administered by revenue. I suppose it'll just remain to be seen how onerous the compliance requirements are. So, as I say, look, we'll continue to engage there. Just a quick roundup of the agricultural relief: the extension of young trained farmer relief for stamp duty, the extension of farm consolidation relief for stamp duty, farm restructuring relief from capital gains tax, young trained farmer and registered farm partner stock release have all been extended, and there's accelerated capital allowances for the construction of slurry storage facilities. So they're just some of the measures that have come in from an agricultural point of view. Also, just to know from the agricultural point of view, the flat rate VAT compensation percentage has reduced to 5%. So I think that's the first time it's reduced in quite a while, even though there's been a bit of, it has reduced before, but I think it's been the first reduction in some time. So just keep that in mind. And quickly, just on the last few VAT measures, hospitality, the 9% rate of VAT, which is currently in place for the benefit of tourism, will cease after 28th of February. For newspapers, the Minister announced a reduction in the VAT on newspapers to 0 rate from 1 January, and that includes digital editions. Health products, automatic external defibrillators will now be taxed at the 0 rate. In addition, non-oral hormone replacement therapies and non-oral nicotine replacement therapies will be 0 rated from the 1st of January. And the 9% rate of VAT will be extended for gas and electricity to 28th of February 2023. The measure was due to end at the end of October. So there is a very, that's as concise a roundup as I could give you on some of the tax issues. Look, I see the Q&A box went up there, so we'll have a look at that over the next while. But back over to you now, Jeremy, for the
Thank you again. You fitted a lot into your 20 minutes there. So a very, very comprehensive update, just like last time. It'd be great if you could take a look at those Q&As. As I said, for our typical audience, your segment there gets the typing going, and there's lots of questions. Hopefully you can answer some, and we'll be back to you by 11:30 or so for some of your comments, if there's any teams coming from it or anything else you'd like to clarify. But yeah, thanks especially for the ongoing interaction with revenue as well. September is a very busy month. I know some of these issues can progress a bit further than others, and even coming from the budget there, just to get clarity on things like the energy supports for case 2, different things like that. So thank you and your team for all the ongoing interactions, and of course you guys are contactable as well by members. So Gerald, thank you again. I will talk to you again in half an hour or so. And listen, for the next segment, I'm going to hand you back to Conal. And Conal, I know yourself and Damien are going to talk to us about another sector that's going through such periods of change and turbulent time, the investment market. And I know you're going to touch upon pensions as well there again. So Conal, Damien,
thanks
Damien,
very much.
You're
Jeremy.
very welcome to join us, of course.
Thank you very much, Jeremy. And thanks, Damien, for coming on. Damien from Accuvest, our sponsors. Delighted to have you on. And Damien, just taking the last item first there, looks like you're the man at the moment. Pension schemes subject to quite a lot of change, but help it is at hand. I mean, they've got a deadline, I suppose, for this year for to audit and prepare full accounts for years ending up to after 31 July. But if they make a commitment by the end of the year, they've got another 12 months to finish up. But still, no, they do have a deadline, and if they don't make that commitment by the end of this year, presumably they'll have to do a set of full accounts and audit them and so forth. Why did it all happen, Damien? What was the motivation in this?
Well, thanks, Conal, and good to be here again to help have a chat with yourself and the members about the issues that are of interest in the day, I suppose. In relation to the master trust, this has been coming for a while. There's regulation called IORPS, which is a bit of a mouthful. IORPS 2, which came into effect in Ireland over a year and a half ago, nearly at this stage. And really what that did is really trying to up the governance bar for pension schemes generally. So previously in Ireland, as you correctly identified yourself, Irish regulator and Irish legislators who had implemented European-wide legislation, they had availed of the opportunity to allow a dispensation for smaller schemes, and Ireland has a massive number of small schemes, probably because of the size of the country, I suppose, but also because of the way in which our tax and revenue and pension relief system allows that and has I suppose encouraged that. But really, I suppose what we're looking at here is that all pension schemes are now being required to be governed as if they were well run and well managed good businesses. And so from a principle perspective, you'd have to welcome the fact that proper good governance is going to be put in place. Obviously, from a small scheme perspective, the implementation of a brand new set of regulatory requirements across the whole industry all at once places a very high burden on everybody because everybody's trying to get to compliance at the same time, and also you've got smaller schemes that are less resourced than larger schemes trying to implement a lot of restrictions and regulations that haven't been implemented yet, and therefore haven't been tested or road tested, I suppose, really. Even at the large scheme level, so really the focus now is on trying to get everybody regulated and everybody into that good governance perspective. What it means really essentially for a lot of those small schemes is that they're ending up having to wind up because there is no sense yet of whether or not the regulations can be run in a relatively light touch fashion. Because the overall frameworks are still being implemented even by the largest schemes, and everybody's in that discovery process in order then to try and develop and implement a framework. For a small scheme that doesn't have resources, it's just not really very feasible. So really what you're ending up is a lot of people looking to move into master trust arrangements.
And so
from a regulator perspective, it's a win-win. Like that's where they've been trying to get to for a long time in the Irish market. They've been trying to significantly reduce the number of schemes in the Irish market. I think there's in the region of 8,000 group schemes in the Irish market, in the region of another 70, 80,000 individual schemes. And the regulator has come out to say that they really would like sort of 200 odd schemes, so from 8,000 down to 200, and those individual arrangements, they don't really want them to be in trust arrangements at all. So that's where we are.
So insofar as our members are asking, what do I need to be saying to my clients who have pension schemes? What are the key aspects of a master trust that they should be? What questions should they be asking?
Yeah, and it's a good question, and I suppose the key thing that they need to do is they need to make sure that they address the problem, I suppose, and inform themselves, because one of the things that we've seen, and we've seen actually since probably this time last year, is you've had a lot of the large master trust providers out there using this as and a lot of industry providers using this as an asset grab type opportunity, I suppose, and really what you want to, and a lot of them have gone, a lot of providers have gone to their existing customers and said, listen, you've got this big high regulatory burden, it's going to cost you a lot of money, here's a ready-made solution, move into our master trust. What we want to, what I think is important from a member perspective, or from a practice practitioner perspective whose clients are asking the question, is that you need to make sure that if you are a provider of a pension solution or a trustee of a pension solution, that if you're making a change, that at least you've looked at the market and you've asked the question, is the change appropriate? Is it the right one for my members? And therefore, have I looked at that? And the regulator has, I suppose, in fairness to them, has emphasized that trustees and existing employers should be asking the questions and shouldn't just jump willy-nilly into the easiest available solution, which I suppose as deadlines get closer, it is a very tempting thing to do. The things that you need to have a look at in summary, I suppose, is really to look at, you need to have a familiarize yourself with who are your existing members. So have an understanding, and that sounds obvious, but you need to have a sense of, are they old, are they young, have they got big pots, have they got small pots? What sort of solution is going to make sense for them? And have I had a chance to look at that? Has that information been provided to me by the existing administrator relatively recently? So at least I know what I'm talking about when I'm moving. Because don't forget, a pension scheme, while we talk about pension schemes being pension schemes, especially on the DC side of stuff, really what we're talking about here is you're talking about a combination of lots of individual pots, because individual members experience what they experience in the pension scheme, and what happens to their individual pots is what's going to impact their individual experience. Yeah. So you need to have a look at things like, you need to have a look at the charges in the new arrangements. You need to have a look at, what are the investment solutions that are available in the new arrangements. Does that, are they appropriate? Are they similar to what I have at the moment? Is it good value versus the current arrangements? Is the default investment option, is it familiar? Is it suitable? Do I like it? Can I say that it's better than others in the market, or better than what they have at the moment at the very least? And then looking at the degree of flexibility that the members will have when they get to post-retirement. Will the Master Trust allow them the degree of flexibility that they have at the moment? Will it allow them sufficient flexibility? One of the issues that's hard to get to the bottom of just yet but the pensions regulator has, I suppose, in fairness, and pointed out, is the issue with conflicts within the provider, at the moment. So if you've got an existing scheme, you've got the ability to select providers. So you can select the administrator, you can select the investment provider. Theoretically, you could select different people for those roles. Within a master trust, theoretically, again, the Master Trust are supposed to review providers, and as part of this new governance of pension schemes generally, the IORPs, schemes are now required to demonstrate that they do look at the providers over, every 3 years. But you need to look at, is it realistic that, an insured provider is going to choose a different administrator, or are they going to choose a different investment solution if they happen to be better or worse? So you need to just be aware of that and make sure that you've looked at what the process is that's in place to protect the members, because really, some of the, I've seen an analogy from the UK market where they talked about the move to Master Trust being a little bit like a Hotel California. Once you're in, you may find it not that easy to leave. So we need to make sure that before you jump people in there, that you've done the sensible thing, and you've asked the right questions. Again, you need to remember that either as an employer or a trustee, you do have that fiduciary duty towards the members. The members aren't that informed a lot of the time, or not in a position to make decisions. They have to go within the framework that you provide for them.
Well, I mean, I think it's a good thing that the investment managers perhaps are more effectively challenged on their investment reports, which to me tend to be glossy, if that's the word I might use. And a bit more challenge wouldn't go astray as to, well, what did you buy? Why did you buy it? What did you sell? Why did you sell it? And so forth, just to understand how they're moving, and also how this typically affects an individual member. They tend to say, well, each one is different, but just pick a few examples and show us how what's happened during the years is going to affect them. So I mean, I think there's a lot could be done to improve the governance generally of pension schemes. So this is hopefully a good move. And you guys are involved in giving advice to trustees on that.
Yeah, we do. In our institutional business, we've been involved in advising trustees and companies for a long time on running pension schemes well, and so a lot of schemes we've been advising them on how they should get up to speed with the IORPS requirements, run the scheme well, make sure that they're done. And we've done reviews of some master trust providers for some schemes that are too small to be in a position to continue on a standalone basis. And so you can do a very in-depth, full, wide market review, or you can do a relatively focused one. But it is important to make sure that at least you can demonstrate that you have asked the right questions, that you have reviewed, that you have considered, and you've watched out for, you at least have the opportunity to be aware of any red flags that are there.
Absolutely. Okay, thanks much for that. And just to move the conversation along perhaps more broadly, the world is in its usual state of chassis, with inflation, interest rates going up, inflation, huge uncertainties out there as to what is next. God forbid. I mean, the worst case scenario seem to be worse than they ever were. Clients with some wealth they want to protect. Any words of advice to give to accountants to pass on to their clients?
Yeah, I mean, it is, as you said, it's very interesting times. And you look at even the economic backdrop that we're in at the moment, you've got, economies still with, lower economic capacity than they would have had pre-COVID, because labor market tightness is very, very tight across the world. You've got people that, that aren't necessarily as engaged at moving back into the workforce, and all those issues that we've had as consumers have, tried to come back out and re-engage and re-emerge in the world. You've got, I suppose, impending talk of recession. You've got slowing economic activity, and really, declining consumer confidence. Obviously, you've got the geopolitical uncertainty that's there in the background. You've got obviously the Russia-Ukraine issue with recent escalations in terms of, I suppose, mobilizations, and the possible prospect of non-conventional weapons being used for the first time, which is quite frightening. Yeah, you've obviously got Chinese Communist Party Congress going on this month, and you've got US midterms. So there's lots of stuff going on. Even here in the EU, you've got a change of government in Italy. We've got a new government in place in the EU, and a new prime minister, I suppose, and cabinet team in place in the UK, with all of the impacts that we've seen on markets over the last week from all that. So markets have had a lot of stuff to digest, I suppose. And really what we're seeing this year is you've had a very strongly negative equity market in response to, higher inflation that we're all very aware of, energy crisis, and that's feeding into food inflation and general price inflation coming through very highly, with 10% prints now in September in the EU, and you've got the central banks really coming out now and emphasizing that they will continue on those rate hikes, irrespective of the likelihood that that's going to bring a recession on board. So from an investor perspective, really what you end up with is you've got either people that are fully invested and have been invested for quite some time, and aren't sure whether or not they should maybe pull stuff out of the market at the moment because of the uncertainty that's out there. Or you've got people that have been waiting to invest and have maybe some cash on board, and they're saying, well, should I wait to put it in? And really what we're saying is the answer to most of those questions depends on your individual circumstances and your short and long-term needs, your investment horizon. But really, for most clients, what we're saying to both of those questions is no is the answer. So really what you want to look at, if you are an invested client, what you need to look at is the movements in markets that have taken place are likely to have messed around quite a lot with your asset allocation. So you probably have quite a different mix of assets now than you might have had earlier in the year. And so you need to have a look at that, make sure that what you have now is appropriate for you. Use this opportunity maybe to rebalance. And if you are someone with cash and you've been holding off, really from our perspective, you're looking at equity markets that are, down, 20-25% from their peaks. And while there may very well be further falls to come, you're kind of thinking, if I'm buying assets and I've got a longer term investment horizon, this isn't a bad time for me to start, averaging into those markets. And so we've got some clients that have a good long plan, that know exactly where they're going. They have expected that, markets do have volatility and periods of high volatility like this, and they're starting to maybe use this opportunity to buy a little bit more than they would otherwise have done. What obviously in the short term, having some cash in times like this, at least interest rates are coming up a little bit. So that's, so it's not quite as penal as it would have been in the past. But having inflation running at 10%, means that, holding that cash for medium to long term is going to end up losing your money over time. And so really, while we wouldn't be rushing people out of cash, it's always good to have a little bit of liquidity and a little bit of dry powder, which gives you the opportunity, to use that, in market uncertainty, and avail of opportunities that will present, as assets do fall in value. Generally, what you want to do is make sure that you have a sense of where you need to get to, what type of a strategy is going to get you there. At the moment, you've got high inflation, you've got higher increasing interest rates. There's a possibility that bonds might start to become attractive again, as we, close out this year. We don't think it's quite there just yet, because on a real basis, you've still got very strongly negative returns from those assets. But really looking at, having an exposure to real assets, maybe some diversification within your portfolio, and really have a plan and then invest with confidence that will give you, and that's really what you need to do to move you forward through very uncertain times like this, because the last thing you want to do is be sitting on your hands, afraid to even ask the question.
Absolutely. And look, I mean, I know you guys are professionals in that area, and obviously that's It's good to hear from you. It's great to hear your insights. The one thing I just would warn our members just against giving direct advice to members. You, generally speaking, that is a separate assignment. You have to have proper investment business authorization, and basically you have to treat it as a very structured assignment if you give personal advice to members. But actually to your clients, I should say. But it is not. But anybody can say to a client, take a look, react to the situation, get advice. So there's certainly a call to action there, which I think that people should take on board. Damien, listen, that was great. Thank you very, very much. Are you able to stay on to answer any questions that we might have?
Absolutely. Anyone has any questions, please obviously reach out to me directly, or to Conal and the Practice News team, or my colleague Angus Moran. So we're always happy to speak to members in practice and to help them, with any queries their clients might have, or even a bit of uncertainty themselves in terms of how they might approach things, because it certainly is, as Jeremy said, back to the old Confucian time. It really is interesting times at the moment, but that's where we find ourselves.
I see two specific questions which we'll get to towards the end, if we can. I don't know if you've seen them, Damien. There's one just very, actually, if we could just take this particular one: executive pension plans issued by life insurance companies, are they treated as pension schemes or for the purpose of the new regulations? I think it depends is the answer to that one. Is it? Am I right in saying that?
Executive pension schemes are pension schemes as well, so they are falling under this. Yeah, so it depends if so PRSAs fall outside the legislation, but the executive pension schemes typically they're falling inside it. So really that's one of the things you need to have a look at. The insured providers are developing solutions at the moment from a master trust type solutions, and we would expect those to be coming on the market sort of over the next month or so in advance of tax deadlines. But really, if you have a pre-existing one, as you said yourself, Conal, you do have a little bit of a window and a transitionary period. But for new investments, you need to make sure that you've had a look at the regulations and don't just barrel money in willy-nilly without at least a sense of what's coming down the line.
Sure, absolutely. Damien, that's marvelous. Thank you very, very much.
Thank you very much, Conal and Jeremy. Thanks a million, guys.
Thank you.
David,
pass back to Jeremy.
Very, very informative session. Yeah, lots of changes in the pensions world and the investment market. Turbulent times indeed, and that's not overstating it. And you have the contact details there for Accubest and for Damien if you have any questions. As he said himself, he'd be delighted to have a chat with you. And we'll maybe back to Damien at the end as well if there's any specific teams or different things to have a chat with him on. Listen, Conal, on to the next segment. And as I mentioned earlier in my introductions, I'm delighted this morning to be joined by our professional accounting team, by Dee Moran, Lillian Halpin in the middle of our pictures here, and by Mike O'Halloran. Dee, Lillian, Mike, great to have you on Practice News. I know for yourself, Dee, and for Mike, it's your first time, and Lillian, you're back and joining us for a second time. And I know actually, Conal, if you click ahead, and I think you have combined this into our existing slides, to say to you guys, Dee has been very good and her team to put together some extra slides on the topics we're going to cover here this morning. And we'll actually include these slides in an updated pack that will go out to you after the actual webinar in our survey and so on. So don't be worried if you don't see the slides in your PDF and so on, you'll have them afterwards. But Dee, as I said at the very start, to kick off, we've a very, I suppose, a packed agenda to get through in our 20-minute segment. We'll do our best, as I say to you, and if we go a couple of minutes over, stick with us as well, guys. But the first thing, I know your team, and I put it down in the actual headline news, in one way, our conduit, our voice, represented members with key bodies like the company's registration office in the Republic of Ireland, Companies House in the UK, and also with the Department of Enterprise, and some of these teams we touch upon here. Dee, firstly, I know you've a couple of things and updates to give us, particularly around the CRO. Very busy time of the year now as we come to a peak filing period. The CRO, as we all know, have had, like us all, a challenging couple of years, new systems, and sometimes I know practitioners have been frustrated, as I'm sure the CRO have themselves, with issues and so on. Listen, Dee, to kick off, can you tell us about your recent interactions with the CRO and give us a bit of background on any plans they have going forward?
Absolutely. Morning, Jeremy, and morning, everybody. And thanks for having us on this session. So yeah, I suppose since the very start of the pandemic, we've had a lot of interactions with the CRO, primarily around extension of annual return filings. And when the new CRO portal came in, we obviously had a lot of interactions with them, with the issues on that. So I certainly do look at member queries, and thank you very much to anybody who sends them in. We do liaise with the CRO extensively on them. We tend to do more general than the individual ones. But our recent interactions, we've had quite a few emails from members just on the B10 filing, and we know back in the early summer this was at 10 weeks. So been chatting to the registrar on this. This dropped in September to about 6 weeks, but I just had a communication from her earlier to say they've really focused on it, because obviously they want to ensure that these are up to date in advance of the heavy filing period coming up. So she has said they're pretty much up to date to the 1st of October for forms. And that anything that hasn't been processed for before that date, it just needs extra scrutiny. So I think it's actually great that they have been looking at this, and that there are updates on them. So if there are any other issues, please let us know, and we will certainly continue to liaise with them.
That's very welcome news, because yeah, you're right. I know, and a lot of their staff, like in so many government bodies and in so many things, are working from home. There's been a massive backlog, of course, so that is good, as I say to you. And I know even by my own filings, I've been amazed to see 8-10 weeks of delays and actually getting prompt responses and different things. But that is great to hear. Listen, moving away from that particular issue, I know you have some other, I suppose, information on upcoming things, and something we mentioned as a news item in our last actual show. And I mentioned as well with relation to the UK version of this in Companies House, the provision of directors' PPSN numbers to help verify directors of entities and transparency and so on. You've a little bit of news for us on that.
Sure. Well, I suppose just really updating what's happening on it. So this is coming in. It's part of the Corporate Enforcement Authority Act, but this section has not commenced as yet, and there is a requirement for directors to provide their PPSN. We are expecting that it will commence in Q1 of 2023, so certainly I think it's time to prepare for it. The CRO are preparing at the moment. They're updating their systems for it, and the registrar has set up a working group to look at all the issues that there may be with this. And I'm actually sitting on that working group myself. There's a number of accountants, there's a number of solicitors, there's a number of company secretaries on it. So certainly our first meeting, I thought, was really good in terms of just outlining to the registrar the myriad of issues that there might be with this. And I know they have taken those away, and they're looking at them. I suppose there was a fair bit of learning from the introduction of the RBO back in 2019, because I think there were a lot of issues on that, and certainly the CRO are taking the learnings from that. So we will continue to update members on this. So just keep an eye on our website. We'll have it on e-news. We will work with the CRO on comms to go out on this. And once we have a date, we will obviously let everybody know on it.
That's great news to hear that there is, I suppose, such a strong process behind it, and that there's going to be a project to ensure this is, let's not underestimate it, quite a big undertaking, but that it'll hopefully all go off very well, and it will take a bit of a lead in time as well. Thanks for that very detailed update on the CRO. I know, as I say, yeah, we're coming into a busy period, and so I'm sure there will be certain issues and different things as they emerge purely with the volume of things over the next 6 or 7 weeks into the end of November. But it's great to have that update. I'm not sure, you may have other news on the CRO, but I also know, Dee, that you wanted to talk with us as well about something that's coming a little bit more down the line, but still that all accountants need to be aware of for their clients, and particularly if you have larger clients at the moment, around sustainability reporting. And I know previously back in February, delighted to be joined by our own sustainability lead, Susan Losney, on the Practice News. And I know Susan will be back soon, actually, probably early in the new year for a segment on this. But I know there's been a lot of changes on the international front. Tell us more.
Sure, there certainly has, Jeremy. And this is just an alert to members. I know probably many on this webinar may not look at this in their day-to-day work, but I think, you know, as accountants, it's really important that we keep up to speed on what's happening on it. So just two very brief slides. At global level, the International Financial Reporting Standards Foundation, the IFRS Foundation, they set up the International Sustainability Standards Board, which is the ISSB, and that was following consultation, because I think everybody felt it was really important that we had some form of global standards, because there were many voluntary frameworks on that out there. So they did, in March of this year, they put out the two proposed sustainability disclosure standards, one on kind of general requirements and one on climate related. So they're known as S1 and S2. I suppose what's nice about these is they are building on other frameworks such as the TCFD, so at least we're not actually starting from scratch. And, you know, the intention is that they would work with the national standard setters to ensure coherent application. So, I mean, they are being worked on at the moment. There was a consultation over the summer. They had a huge amount of responses to it. So they are working through those. And again, we will keep members updated on our website on it. I think what's very important is that they have also undertaken to work with Europe, because many members will be aware that the EU have put out the CSRD, which is the Corporate Social Responsibility Directive. And there have also been two consultations put out on this. And next slide, Conal, please. Thank you. So this is just a slide on the CSRD, just to give you some flavour of it. So the CSRD, when it comes in, it will replace the non-financial reporting directive, which has been in place since 2014. And the NFRD applied to about 11,000 companies in Europe. The CSRD will apply to 50,000. So it is really going to encompass a lot more companies. Scope of reporting is going to be very forward-looking. There is a double materiality concept where you have to look at the financial impact and the environmental / societal impact of what the company is actually doing. It'll be applicable to companies that meet two of those three criteria. So 250 plus employees, 40 million in turnover, and 20 million in total assets. And interestingly, there will be, for the first time, there'll be a mandatory limited level of assurance. There were some EFRAG produced some draft standards on these in April 2022, which the Institute formed a working party and responded to. There are 13 draft standards in it. You know, I think there was a lot of detail. We certainly went back with just a number of issues that, as did many other parties. But they're working through those at the moment. But they are saying that the first set of sustainability reporting standards will be with the European Commission in November of this year. So we're really interested to see where they end. But I think for members, you know, it's really good to keep an eye on what's happening with the CSRD. While it will apply to the companies with that criteria now, it will continue to apply to smaller companies in the coming years. So again, we are keeping our website updated for this. our consultations, etc., are there. So, you know, I would just encourage everybody to keep an eye on the website for it.
Thanks for that update, and you're right. This is something not on the immediate horizon for practitioners, for SMPs at the moment with SME clients, but I think by the mid part of the decade and towards the end of this decade, this is something that on the reporting front is going to be applicable for all sizes. So it's a little bit of a one on the horizon to watch out for, and great to have that guidance. And I'd say to anybody, and I've been the same myself, is to if you want to learn a little bit more about the sustainability area, we have a hub. We have this information all on our technical hub, but also on a sustainability hub. So that's great. Dee, thank you for those contributions. Next, I'm going to have a brief chat with Lillian. And Lillian, as I mentioned, and I think I probably stole some of your slide there as well in my news piece, you were very busy with the team there back in August, kind of pulling together some of the key legislation changes on the SCARP and on the CEA Act to show how they impacted on the Companies Act 2014 into a very useful guide. Tell us more.
So yes, thanks, Jeremy. Yes, there was a significant enough amount of legislation this year, and the Companies Rescue Process for Small and Micro Companies and the Companies Corporate Enforcement Authority Act, they mainly dealt with the SCARP process in the first act and the Corporate Enforcement Authority in the second act. But there were changes brought into the 2014 Act as well, technical amendments. So yes, I just went through those amendments. There were in three areas, mainly to the 2014 Act, in the share capital area, the corporate governance, and then miscellaneous. So, for example, on the SCARP Act, there was a smaller number. So that was, as you said, there was so I'm going to focus on the 2014 changes rather than the actual SCARP process or the Corporate Enforcement Authority, which had been dealt with elsewhere. But on the SCARP Act, yes, there were changes to the Committee of Inspection. So liquidators now need to make sure that creditors in a court-ordered liquidation are made aware of their right to form and be on committees of inspection, and that there are employee rights there on committees of inspection as well. And then there was in the SCARP Act again, the process advisor was enabled to have electronic meetings, so during the interim period. And then so more significant then are more changes in the CEA Act, which was brought in during the summer. And then on the share capital side, there were technical amendments, but nonetheless important for practitioners. For example, in the Companies Act 1963, it allowed a company to do certain things with its share premium account, but those sections were dropped unintentionally, it's thought, in the CEA, in the 2014 Act. So it meant that if you wanted to do, for example, write off company preliminary expenses, that there might have to be a formal reduction in capital, and that would be going through the process of the summary approval procedure or a high court confirmation. So obviously attendant expense and complexity. So what happened was that the 2021 Act put back in the enabling provisions of the 1963 Act that were left out of the 2014 Act. So that guide that you mentioned. So yes, and then corporate governance, there was amendments like a secretary having to be over 18 as well as the directors. And then on the miscellaneous front, the Corporate Enforcement Authority has power to request evidence from a person that they're qualified to act as a liquidator. So yes, as you mentioned, that guide pulls all together. So I think it's quite useful. It's up on our website, and you've given a link to it. So
brilliant. No, some very useful guidance there, and I know it took a lot of work, I'm sure, to put all that together. And I read it there myself in recent weeks. And it's just in 7 or 8 pages, so easy to get an overview of that. So thanks, and a great example of what you and your team and the sort of guidance you get out, as I say there. I know, Lillian, as well, you will be involved in, of course, developing other guidance and keeping an eye on upcoming legislation that will impact on our members, but also maybe with their clients and so on as well. And looking ahead to the legislative framework for the Republic of Ireland, planned acts and so on, as I say, to draft legislation in the autumn period. You have two there you'd like to talk to us about around insolvency and also around the whistleblowers protection of employees.
Yeah, well, sorry, first of all, just to say on those two bills that I've listed there, it's just really emphasised that we keep an eye on forthcoming legislation. So 3 times a year, the government issue a legislative programme, and I just have a look through it and see what acts might be, what draft legislation might be something that will impact on members. I've identified 2 there. I'll come to the whistleblowers in a minute, but 2. So one of these, the first one there, I think it started out as the Companies Miscellaneous Provisions Act or bill in previous legislative programme, but it's morphed into this legislation. I have to emphasise, we don't know what's in it. We know that there are going to be further changes to the 2014 Act. There's been no heads or anything issued, so it's just really a heads up that there are going to be further changes. We keep an eye on things. We liaise with the department as well as others. We did a survey for the department on the whether people thought that we should keep the virtual AGMs and EGMs on a permanent footing. So we did a survey of members during the year on that and fed the results back to the department, and people do want to keep that. I don't know what's in the legislation, but when it comes out and there's things of interest, we let members know. So that's on those 2 there.
Great.
Okay.
So the next slide there, Cornelia.
So then the other thing, yes, just to note, this is actually this legislation has been signed into law. So it's the Protected Disclosures Amendment Act 2022. Now it hasn't been commenced yet, but it is something that will change things up on the protected disclosures front. And it's and so, as I said, it hasn't been signed into law, but it hasn't been commenced, but it's been signed into law. So I can tell you what just a brief guide, a brief summary of what the changes are. It's going to widen the scope of protected disclosures legislation. It's to give effect to an EU directive, and it means that people who can make a protected, so we make a protected disclosure and you're protected if it's a particular type of disclosure that's covered by the legislation. And currently it's workers, and there's definitions in the 2014 Act. It's going to be expanded, so it'll include shareholders and volunteers, recruit people who get information that they want to disclose, make a protected disclosure about in the process of recruitment. So it's going to widen that. It also expands the relevant wrongdoings that if you make a disclosure, you are protected. So it's breach of EU regulations have been added as well, and there's an annex in the legislation. So it's kind of, if you're in the area of, say, product safety or transport safety, those organisations in those areas, so they're now covered. And then there's going to be the net of organisations that have to put in place whistleblowing procedures, and there's quite a piece of extensive, procedures that you have to set out now. So over 250 employees and public bodies and a certain amount of organisations I'll come back to in a second. So if you've over 250 employees, a public body or these other organisations, once the Act is commenced, you have to have this internal procedure. If you're between 50 and 249 employees, you have to have it by the end of December 23. And then if you're under 50, you don't have to have it, except if you fall within one of the organisations identified in the legislation as, say, in the anti-money laundering area, financial services area, which listed there in the legislation, then you have to have those internal whistleblowing procedures. So as I was saying to Jeremy there the other day, I'm working on putting up some resources, web pages for members, so they can just get the basics of who's covered, what's covered, what you have to do as regards, the internal procedures and external procedures as well. So I hope to kind of have that done by the end of this year. It'll depend on when the legislation commences as well. Introducing the resource. There is an Office of the Protected Disclosures Commissioner to be established in the Office of the Ombudsman. I'm hazarding a guess, maybe they're putting that in place before they commence the legislation. So I don't actually know when it's going to come into force, but it's certainly signed into law. So and as soon as it does come into force, we'll put as usual, we'll put items in e-news and let members know about it. So
brilliant. That's a great benefit as well, I think, to have that update for our members in practice. when you mentioned right down to 50 employees and above, that captures even some of our bigger small practices, and definitely advising their clients as well in that category of 50 to 249, the SME clients and so on. So good to know about that. It's going to, I'm sure there could be some questions, maybe not particularly to accountants, but to know that the practices will have to put this in place, as well as I say to you, and that certain practices, but also that their clients and so on. So to make everybody aware that, yeah, that guidance when it does, when the law is formally enacted, and as I say to you, would be great to have. So we'll keep an eye out for that. Lillian, thanks for your time there. Mike, you've been sitting very, very patiently there, but I finally get round to you. And Mike, I know you've been keeping busy as well, more on the financial reporting side of the house in the last while. And I know the FRC with its periodic review and also its ongoing threads and updates is keeping you busy and replying to consultations and getting member input again. Tell us more on that.
Yeah, thanks for the introduction there, Jeremy. Yeah, so the first half, or the first part of my section here, I'm just going to look at some recent consultations that have gone by in the past, and one particularly large one that's coming in the future. And I suppose generally within the Institute, we try to respond to as many consultations of relevance to our members as we can. They form a very important part of the due process for standard setters. And when we're talking about standard setters, typically we're speaking about the FRC and the IASB as the financial reporting standard setters. So consultations, they allow the standard setters just the chance to engage with the stakeholders, to see, to let them be part of the conversation and to see, well, what's working, what's not working. Are there any maybe potential unintended consequences from any ongoing consultation? And within the Institute, we have our own financial reporting technical committee, and responses to consultations of a financial reporting nature are typically formed by this committee. So a letter from the Institute in relation to a consultation, it's obviously not one single person's opinion, it's a balanced view of several members that then comes to form the overall Institute response. So just on my first slide, I have two recent UK consultations that we've issued responses to. I mean, it's also worth noting we've put in several IFRS international consultations as well. And when you do get the slides, I've linked our consultation response page on that, just to allow you to read them in your own time. So FRED 79, and when we're speaking about FREDs, it's short for Financial Reporting Exposure Draft. So FRED 79 is Financial Reporting Exposure Draft number 79. And that related to the FRS 101 annual review. So FRS 101 would be well known to many of our listeners. And in a nutshell, it's a financial reporting standard that just allows an entity to apply the measurement and recognition requirements of full IFRS, but with some reduced disclosures. So it's typically used by certain qualifying companies whose parents prepare consolidated IFRS financial statements. So the FRC carries out an annual review of FRS 101 just to look at what developments have happened at IFRS level, and then to see, well, are there any changes we need to make to FRS 101 as a result of whatever changes have happened at international level. And FRED 79 just formed part of this annual review, and quite a straightforward one. It proposed no amendments to the standard. So I suppose just the key takeaway from FRED 79 is that for anyone applying FRS 101, there's no change as part of the 21-22 cycle. So then FRED 80, and that dealt with an FRS 100 update. So FRS 100, it sets out the applicable financial reporting framework for entities preparing financial statements in Ireland and the UK. And there were some changes made a couple of years ago to FRS 100 just as a result of Brexit. But accompanying the FRS 100 standard is some application guidance just relating to how equivalence is determined for the purposes of the standard. And FRED 80 just builds on that equivalence guidance, and it also separates out the Irish and UK guidance. So I suppose if you were to ask yourself, well, where can you use or apply equivalence? There's probably two key areas. The first area is when you look at FRS 101 and 102, there's certain exemptions from disclosure available, subject to there being an equivalent disclosure made in the consolidated financial statements of the group where the company is consolidated. And an example of this is section 1.12 of FRS 102, whereby you have certain qualifying entities and there's certain disclosure exemptions, but they're subject to an equivalent disclosure being made in the consolidated financial statements. The other area where you might use or apply equivalence is, for example, where you have an Irish company who has to go to Section 300 of the Companies Act to claim exemption from consolidation. You may be required to assess if your parents' consolidated accounts are prepared in a manner equivalent to the EU Accounting Directive. And there's a similar provision then contained in Section 401 of the Companies Act 2006 for UK entities with a non-UK parent. So this thread just proposes some amendments to the guidance within FRS 100, just on how to apply equivalence, and hopefully it should make it easier for the preparer to assess equivalence under Irish and UK company law. So that's thread 80, and just before I move off this slide, just a reminder that we have a link at the bottom of the slide just to our consultation responses. It's not just financial reporting responses, it's audit, insolvency, and any other areas that we've issued a response to the regulator with during the year. So then on to the next slide, the FRS 102 periodic review. So FRS 102 will be very well known to most of our attendees today. And it's likely that the next periodic review of FRS 102 will commence in the next few months. So what is a periodic review? Ultimately, it's a scheduled review by the standard setter of the standard after a period of time. And that just allows the FRC to consider, okay, well, what changes have been brought in at IFRS level? Are there any changes to the IFRS for SMEs? And should we now consider bringing these changes into FRS 102? And it allows them as well just to consider any other stakeholder feedback as well. And typically, we expect these periodic reviews to happen every 4 to 5 years. So we're now at that point where a new periodic review kicks in. So the last periodic review happened it resulted in amendments that commenced on the 1st of January 2019. And there was a lot of changes back then. I mean, we could cover probably a couple of hours just going through all the amendments back then, which was to be expected, as it was the first review of the standard, or the first periodic review of the standard. I mean, some of the key changes back then, I mean, you had undue cost or effort that was removed. We had a new section brought into Section 11 just to allow you to determine whether a financial instrument was basic or complex. And there was also a reduction in the number of unnecessary disclosures, whereby the deemed cost of preparing the disclosure outweighed the benefits gained from that disclosure. So last year, the FRC, they kicked off the initial phase of the periodic review, and they issued an invite to stakeholders just to submit their views on the review. And you'll see on the slide, when you get the slides, there's a link to our response within that. But some of the key points that we highlighted there were, the need to road test new requirements that might be proposed. So if the FRC go down the route of bringing in the requirements of IFRS 16, IFRS 15, etc., well, there's an important need to road test those requirements just to see that they'll operate as intended. We also highlighted the potential for including necessary simplifications for smaller companies. I mean, one thing that's very evident when you look at the users of FRS 102 is that there's a very broad pool of entities that use the standard, from your really small entity to your entity maybe turning over hundreds of millions of euros and pounds, to your charities, to your credit unions. So there's a very broad range of users of the standard. And where there's fairly onerous accounting requirements, we just highlighted the need for necessary simplifications where smaller companies are using the standard, so that the standard doesn't become a burden for them. We also highlighted the fact that the UK is no longer bound by the EU Accounting Directive. And if there were any changes to the standard that would take FRS 102 outside of the realm of the EU Accounting Directive, that Irish entities would need to be scoped out of any such amendments, because we're still, in Ireland, we're still required to comply with the EU Accounting Directive. So the next stage of the process will commence when the FRC issue their exposure draft, and they'll outline their planned changes to the standard. And then we'll have a consultation period where stakeholders can engage with the process. And the FRC have indicated that the effective date will be no earlier than the 1st of January 2025. So what are the big issues that the periodic review might address? I suppose the short answer is we don't know. It's up to the FRC to consider whatever they deem appropriate. But we do know that they typically look at 3 pillars when they're considering whether something needs to be changed. So the first area they look at is, are there any general improvements required? So what have our stakeholders said to us since the last periodic review? Are there any inefficiencies in the standard, anything that's not working right? Are there any newer developing issues? So are there any new maybe financial products in place that weren't in place when the standard was originally envisaged? The next pillar that they tend to look at are there any wider developments in corporate reporting? So things like, are there any changes arising from government proposals? Are the overall levels of disclosure within the standards still appropriate, or are there any narrative reporting developments? And the final area that they tend to look at is, have there been any significant changes in international standards in the recent past? And the three standards that they've suggested that they might look at including within FRS 102 are IFRS 15. So there's a new revenue recognition model within IFRS 15, which is different to the current section 23 of FRS 102. So it'll be up to the FRC to consider, well, do we want to bring in the requirements of IFRS 15 into section 23? A fairly significant change at the international level too was IFRS 16 dealing with leasing, whereby now all leases, subject to a few exclusions, all leases operating and finance are brought onto the balance sheet, whereas under FRS 102, obviously it's only finance leases that get brought onto the balance sheet. And IFRS 9, there were some significant changes at international level as well, just in relation to things like the expected credit loss models. So it's up to the FRC at the moment to consider, well, what's appropriate to bring into the standard, or do we bring in the full requirements of these standards, or do we include necessary simplifications to ensure that, you know, that smaller entities are looked after as part of the process. So that's the upcoming periodic review of FRS 102. We haven't got a release date for it yet, but the indications are that it'll be released before the end of the year, with a consultation period then to follow. So just very briefly on the next slide, I know I'm probably eating into the time here. We have some recent projects and technical hub material that we've recently added to the site. The first one there, we've an article just on the financial reporting implications of the war in Ukraine, so under FRS 102. So we've just looked at some of the key areas where financial statements might be impacted by the war in Ukraine, and we've kind of looked at, well, what might be the measurement and recognition implications here, and what might be the disclosure issues. Our FRS 102 Need to Know More series, we've recently released that, whereby we've taken 7 sections of FRS 102 and looked at some key Q&As raised by users of the standard, and we have some examples and commentary to support that. So that was the first tranche that we've released a couple of weeks ago, but it's also an area that we hope to develop in future. Financial reporting for cryptocurrency. This looks at some of the financial reporting requirements for cryptocurrencies. So this is an article that would have appeared in Accountancy Ireland a couple of months ago. And our colleague in the Financial Reporting Technical Committee, Gavin Fitzpatrick, wrote that for us. I guess cryptocurrency is one of these new products with no specific accounting standard. So in the absence of a specific accounting standard, you're required to go back to your accounting principles and address it in accordance with the existing accounting standards. We were delighted to have the FRC over to us in July 2022 for a free event for members. So we had Stephen Maloney and Jenny Carter from the accountancy team there who provided a financial reporting update for members. And we also had Phil Fitzgerald from the FRC lab, who gave us an insight into the type of reports that the FRC lab have put out recently. So that was a very good session with the FRC, and we're hoping to have them over during the consultation period for FRS 102. They're always very keen to engage with our members, and once we have a visibility on the release date for the exposure draft, we'll look in and see when we can have them over. Our weekly technical roundup, that's our newsletter that we put out every week. So I think that goes out every Thursday, but it's also part of the e-news newsletter that hopefully everybody receives on a Friday also. So just keep an eye out for that. It's got whatever updates have happened in the last week. And finally, just on the next slide, we just have a link to our technical hub. That's where we house all our technical material, including some of the documents we've just looked at there. And it's an area we hope to develop further. So just please do visit it and let us know if you have any queries in relation to it, or if there's any particular area that you'd like us to add material to.
Mike, Dee, Lillian, thank you so much for that very, very comprehensive update. Some very useful guidance there that you've actually given to us. I'm sure some of you were familiar with it, but if I was to say to you, the last point you had there, Mike, the technical hub, guidance being added to all the time, and insolvency, audit, financial reporting. It's a tool, it's free and there for you, so please do use it. Lillian, Dee, Mike, thank you for taking the time to join us this morning, for giving those slides. Hopefully you'll stay with us for the next little bit. I'm not sure if there are any questions. Before we get to questions and our roundup, before we get back to Leoncha's tax update, Conal, if you can be good enough to click ahead, I have a very quick update to tell you about some of our upcoming events. And particularly if you're in Northern Ireland, or maybe you'd like to come to Northern Ireland to see us, we're delighted to announce that we're actually going to have our first in-person event in practice consulting since pre the pandemic in March 2020, our Northern Ireland Practice Forum. And the Northern Ireland Practice Forum is going to be held in the Titanic Hotel. I'm sure if you're here in Belfast, very familiar with it. Today, 2 weeks, the 21st of October. And the actual practice forum is going to be broken into two sections. Our morning section, we're going to give the normal technical updates. And if you attended our previous practice forums in 2018, 2019, 2020, you'll be familiar where we cover off topics such as tax. We're delighted to have Alan Gurley, Grant Thornton, and the chair of the tax committee for UK and Northern Ireland for the Institute give his tax update. We're also going to have an economic update from Alan Vidal of Bank of Ireland, a very comprehensive update I can recall in his last forum. And we're also going to cover off with Conal and Aidan Lamb of Professional Standards, just the issues and technical issues you need to know about in practice, audit, anti-money laundering, a quick run through there. Now in the afternoon, because too much technical is bad, you need a break and you need to focus on the growth of your practice. So we're going to actually have a workshop, and we're delighted to be joined by Catherine Martin. You may recall Catherine of Cavan Kelly joined us with Conor Woods in our last practice news. And Catherine has been kind enough to share the Cavan Kelly story, which is very impressive on growth around everything they do, from hiring and recruiting staff, digitalizing their firm, winning new work, different things like that. And so that'll be one part of the workshop. You may be, some of you, familiar with the workshop we've done online previously, but Conal and myself will share this, and that's going to be our afternoon session. We're going to be joined by the Institute President, Pat O'Neill. Great to have Pat along as well. And so if you'd like to come for this, what'll be a jam-packed day, and you want to learn more, if you're definitely from Ulster, I'd say it's a must-have, but even from further afield in the Republic, there's a lot of those issues that'll be relevant to you too. You can learn more at the link there, and we have an early booking discount as well. It's quite popular so far. I think the early booking discount goes until Tuesday or so, so you can learn more there. Listen, Conal, click ahead to the next slide before we get back to questions. Some other upcoming webinars that we have: Anti-Money Laundering Essentials, half-day webinar on Tuesday in the Republic of Ireland. The Essential Company Secretarial Update. We're delighted to have Sarah Culfer of Mazars joining us on Tuesday week for the Republic of Ireland as well. And I mentioned the Northern Ireland Practice Forum on anti-money laundering. The equivalent half-day all-in workshop for Northern Ireland is going to be on the 10th of November. Want to learn more, we'll be sending out more emails and so on as well. Listen, before we get to Leoncha's bit, Conal, you may have questions there, or we may have, it might be some questions as well in Teams coming from Garrod and coming from yourself and Damien.
Indeed, yes. Well, I might just start with one for Damien. I think it's for you, Damien, anyways. First of all, just before I even say that, I just to point out that you've got an article in this Accountancy Ireland, which might just fit people's desks at this stage. So watch out for Damien's article there. But I'll ask you the question, Damien. So be careful with your answer, I'd say. With equity markets down and the ESRI saying property is overvalued by 7%, should we be switching from property to equities, all other things being equal? Ooh, a hospital pass.
Indeed. Well, thanks, Conal. I suppose the answer is that we believe that there's space for property and equities within a balanced portfolio. We wouldn't, equities are the biggest driver of growth generally on an economic perspective, and so therefore they would be the anchor part of most of our clients' growth portfolios. And so we certainly would be strong advocates of having the lion's share of your growth portfolio in equity markets. But in terms of property as an asset class is far from generic. And so it's not to dodge the question, but it'll probably very much depend on, number one, your time horizon, because it's an illiquid asset class. Number two, the type of property that you're holding. When you talk about property being overvalued, that very much is dependent on what property you're holding, where it is, what type of, whether it's residential, institutional, whether it's logistics, high street retail, offices or diversified diversified portfolios. So sorry, but there's no easy answer on that one. But certainly equities are a more generic asset class. It's easier to get access. It's certainly more highly liquid, and so they should form, I suppose, the anchor part of most people's investment portfolio, I would suggest.
Very good, very good. Thanks very much for that. Now, I think, Gerard, you've been busy in the background answering questions there, and I think you've answered some of them directly, haven't you?
Yeah, look, I just like to jump into the chat there just to get it going, but just to bring out some of the highlights there. One of the issues coming up is the number of correspondences that agents and taxpayers are receiving from revenue. So, look, obviously, just not being in the heat of practice at the moment, I wasn't fully aware of all those correspondences, but we'll take that back to revenue, and we can raise that at collections and audit. So, what I would ask is that if you have instances that just where you're getting an awful lot of correspondence, and if it seems alarmist or anything like that, just send it into tax@charteredaccountants.ie, and that helps us when we're going to revenue, just to say, look, we have a certain volume of requests. Obviously, nothing specific, because for all the obvious reasons. Also on VAT RTDs, it was mentioned that they're holding up refunds. Is that, I suppose, strictly revenue are entitled to, withhold a refund where there are outstanding returns. But look, I understand with the RTD, it's a mere statistical return. We got that changed for the purposes of debt warehousing, whereby an RTD wouldn't preclude you from the benefits of the warehousing scheme. But I suppose revenue can do that, but we'll raise it again as a matter of pragmatism. Just one or two other things there that came up around non-resident landlords. Again, look, I know it's the big elephant in the room is what if the tenant doesn't withhold tax? And I think most of us could imagine if we had a non-resident landlord and we're under the age of 30 and we don't know anything about tax, we're going to be saying, I'm not withholding tax, good luck. We're aware of that, but look, the position is still a strict legislative position. So we just you encourage your clients who are non-resident and who are landlords to put arrangements in place where possible. And hopefully most tenants will be willing to play ball. I appreciate the issue of a collection agent is an administrative and a financial cost. So look, where possible, do what you can over the coming months to get arrangements in place. And if there are tenants that aren't amenable to their obligations, look, again, get onto revenue, engage them as soon as possible. That's what I'd say there. And just a quick one that came up there on preliminary tax and when it's underpaid. Preliminary tax is a strict legislative requirement. The limits aren't regulation or guidance. The limits, the 90% to 100% are set in legislation. So what I would say is wherever you realize you may have underpaid preliminary tax, just make a top-up payment as soon as possible. Preliminary tax is also coming up in the context of audits, where strictly, for example, if it comes up in an audit that I have underpaid tax, that revenue can and are in certain scenarios imposing interest from the preliminary tax that was underpaid, even though you might have said, well, I paid that preliminary tax in good faith. Well, it subsequently turns out that your final tax liability was maybe 100 grand, maybe more significant considering if it's an employment tax, something like this. Revenue can impose interest and penalties from the date that preliminary tax was due. So that's potentially an extra, depending that could be almost a year and a half worth of additional interest, or certainly, you're broken at 10 months. So there are preliminary tax is a strict legislative requirement, and unfortunately I can't offer anything beyond what's in the legislation because it has to be complied with. So if you've underpaid preliminary tax or you haven't paid it, the only option is to make a payment as soon as possible, and just as I say, revenue can impose interest and penalties. So look, that's a quick highlight there of some of the questions, just to bring it out. Conscious of time, so look, I'll leave it there.
Thanks very much, Gerard and Damien, for your answers there. Back to you, Jeremy, just to wrap up. I'd say that.
Indeed.
To do the Northern Ireland.
We're going to actually, if you can move on the slide and ask Chris, actually, we're going to go to Leoncha's recording. So for our last, and it is 15 minutes, Chris will be lining up the recording here. Leoncha Doran, our UK tax lead, has been very good to make this recording earlier this week. covering off everything from our ongoing interactions with HMRC on behalf of our members in Northern Ireland and the UK, and also that Maxi budget from the Chancellor back 2 weeks ago now, as I say to you, and obviously all the reaction to that as well. So Chris, if you're good to go, it'll be, I would recommend to anybody, of course, who's Ulster based to check it out, but also if you have clients in Northern Ireland or the UK, and to do check out and stay with us as well for this extra 15 minutes with Leontia. So hopefully, Chris, you're able to line that up. I think you are. I see some change in action.
Hello there and welcome once again to this update on what's happening in UK tax. For those of you that don't know me, I'm Leontia Dorn, the Institute's UK tax specialist with the Advocacy and Voice team. In this recording, I'll be providing you with a short update on what's been happening in UK tax since our last update in June and what we as an institute have been working on for you, our members. So the first key work stream we're going to look at is HMRC service levels. As set out in previous updates, this really is an ongoing matter of discussion with HMRC, who previously were aiming to restore service levels to pre-pandemic levels by the end of March 2022, earlier this year. That has not happened due to what HMRC refer to as specific risks. For example, resources were redirected from HMRC to the Home Office due to the war in Ukraine. And this unfortunately resulted in a reduction in HMRC staff and an increased workload, which caused what HMRC refer to as a perfect storm. However, HMRC are keen to stress that they want to return to normal service levels as soon as possible. One positive is that the Agent Services dashboard is now openly available to you, and you no longer need a login to the agent forum to view this. Now, this is a very useful tool and can be used to check current processing times and service levels for post and online requests. We also expect more up-to-date feedback from HMRC on performance at a forum meeting which will be taking place next week and at which I will be in attendance. But it's really important to say that we have told HMRC that service levels need to be restored as a matter of urgency. Full levels are not expected to be restored until next month, and just to note that this could well be pushed back again. However, HMRC have told us in a previous meeting that additional staff have been recruited. We'd therefore be very interested to hear from you, your views and details of any ongoing areas of frustration or difficulty. My email address will be provided for at the end of the slides, so please do reach out to me at any time with feedback. Now moving on to our next topic, lobbying work. Since my last update in June, the Institute has made 4 submissions on key areas, making that a total of 10 already on the UK front this year. I just want to highlight some brief points on each of those submissions. Firstly, the Capital Allowances Policy Paper. The Institute made a number of recommendations in its response to this consultation, one of which was recently announced in the mini-budget last month, i.e. that the annual investment allowance will permanently be at £1 million and will not reduce to 200,000 from April 2023. We also submitted a response to HMRC's consultation examining the tertiary legislation for making tax digital for income tax. HMRC published various notice for MTD for income tax, and this was open for consultation for a very short period in July. Key points made in our submission were that more detailed guidance was urgently needed. We also highlighted the lack of available software and the importance of ensuring that the more detailed guidance explicitly set out the digital record-keeping requirements for businesses under making tax digital for income tax. We also responded recently to the consultation raising standards in the tax advice market, which examined a number of proposals aimed at protecting taxpayers claiming tax-free payments. So this consultation examined proposals to deal with poor behaviours by some repayment agents. The Institute's submission goes further and examines some of the root causes underlying why repayment agents have been able to set up in recent years. This includes areas such as tax complexity and the UK's tax policy making approach, amongst others. Although we did feel that some proposals in the consultation could assist in mitigating poor behaviours by certain repayment agents, We felt that educating taxpayers to understand how the tax system impacts for them and enabling them to claim reliefs and allowances through a simple online process would actually reduce the number of taxpayers seeking help from repayment agents in the first place. We also made an informal evidence submission to the House of Lords Protocol Subcommittee on the Northern Ireland Protocol Bill. In August, at the invitation of Baroness Margaret Ritchie, the Institute made this informal submission. This focused on the importance of the Trader Support Service being extended beyond the end of 2022. We're really delighted to tell you that earlier this week it was announced that the TSS will continue for a further year to 31st of December 2023. And this was a recommendation by us for over a year now in various letters, consultation responses, and in the Institute's next financial year 2022 position paper. Now that we know the TSS is being extended for a further year, we'll be focusing on seeking a longer-term solution to support businesses in Northern Ireland. We'll also be making a further submission to the House of Lords Protocol Subcommittee now that it has opened its formal inquiry into the Protocol Bill. Again, we'd very much welcome your input and feedback in developing our response, and you can send that to me via my email address set out in these slides. And finally, just to flag here, there is a consultation that has just been launched this week on devolving more fiscal powers to the Northern Ireland Executive. That follows on the recent work of the Northern Ireland Fiscal Commission. Earlier this week, the Finance Minister Conor Murphy launched this consultation on devolution of more fiscal powers to NI. This examines the additional fiscal powers that could be provided to a Northern Ireland Executive to allow locally elected ministers to set taxes in line with local needs and circumstances. Now, this consultation doesn't close until the end of November, so of course we'll be asking for your feedback over the next few weeks and months to respond to this. And finally, I can't finish this session off, this particular part, by not mentioning the Institute's flagship lobbying publication, the next financial year that we published in July. This contains key tax and policy asks of government in NI, the UK and Ireland, and we have already had a number of successes since this publication, which I touched on earlier. So moving on now to the next area for discussion, and that's the recent mini budget. Or should I say maxi budget? It would really be remiss of me not to mention these particular announcements. We all know that the new Chancellor's first fiscal event last month became more of an event than many anticipated. Although the reversal of the corporation tax increase, which was due to take effect from April 2023, was well foreshadowed in advance, the rate, of course, as we know, will now remain at 19%. Many of the other announcements came as a complete surprise, including the disbanding of the Office of Tax Simplification and the abolition of the additional rates of income tax, which of course you'll now know the Chancellor has later done a U-turn on, in fact, earlier this week. So that's not now proceeding, the abolition of the additional rate of income tax. So last month, events really kicked off the day before the mini budget announcements on the 23rd of September, when the Chancellor announced that Thursday that he was reversing the 6th of April 2022 1.25% national insurance increase. And remember, that applies to employee, employer, Class 1A, Class 1B and Class 4. So this reversal will take effect from the 6th of November 2022. So the race really is on for software providers to get their software up to date in time. Also note that the 1.25% health and social care levy, which was due to be introduced from next April, will not now go ahead. However, the 6th of July 2022 increase to the national insurance contributions threshold is being kept. And final point here on the income tax is that from the 6th of April 2023, the 1.25% increases to dividend rates will be reversed. So they will fall back to their previous levels. So just to touch on some of the other main changes. I've already mentioned that the annual investment allowance is going to be set at 1 million permanently. It was due to fall to 200k from the 31st of March 2023. The fall in the basic rate of income tax from 20% to 19%, announced earlier this year by former Chancellor Rishi Sunak, will now take place 1 year earlier from the 6th of April 2023. We also had several changes to the stamp duty land tax residential property thresholds for residential properties in England and Northern Ireland. Firstly, the 0% threshold doubled from 125k to 250k. And then the level at which first-time buyers begin to pay stamp duty land tax increased from 300,000 to 425,000. First-time buyers relief will now be available on property purchases up to 625,000, increased from 500,000. Now, these all changes took effect. They are already in operation for purchases of residential property in England and Northern Ireland on or after the 23rd of September 2022. And finally, the Chancellor also mentioned the introduction of new investment zones where enhanced tax reliefs will be offered. This is in addition to free ports. Now, in terms of how that applies to Northern Ireland, the government did say that it will work with the devolved administration and what it referred to as local partners to make sure all regions benefit if they're willing to do so. Just to also mention, there were a number of other measures announced designed to encourage investment, which you can read about on our website. And the final point I want to make is these aren't the only tax changes. We expect to see more tax changes next month at the fiscal event scheduled currently for Wednesday, the 23rd of November. Now, this is likely to be the autumn budget, but there have been some reports this week that may be brought forward, so watch this space. Moving on now to our next topic, EU exit. As usual, the Institute continues to represent members' views at forum meetings in the context of EU exit. Not surprisingly, recent meetings have focused on the Northern Ireland Protocol Bill and HMRC and HM Treasury's policy proposals. What we have been stressing at those meetings is the importance of certainty, detailed guidance with examples, a soft landing, and the provision of a lead-in time for businesses. These are all key concerns. However, the key message from government is that at present, the current rules apply and businesses will be given notice of any changes. So, although there is no timeline for any changes which may be made and no confirmation of how long any changes will take to implement, just want to stress that the government is very much in listening mode. Businesses will be provided with a notice period in respect of any key changes. Of course, deciphering what can move via the green and red lanes in the protocol bill will be very key to the process. So HMRC and HM Treasury continue their work on refining these policy proposals and continue to discuss these with stakeholders. And final point I want to make is that earlier this week I attended the first joint UK and EU Domestic Advisory Groups meeting. Now, the UK Domestic Advisory Group is a new group which is considered to be an important consultative body that has been established to put forward views to the government on the implication and the implementation of the Trade and Cooperation Agreement. So moving on now to our final topic, making tax digital. At the moment, we are just under 18 months away from the start of making tax digital for income tax. In the last few months, we continued to attend various HMRC forum meetings at which the many barriers to the successful introduction of NTD for income tax from April 2024 were discussed and highlighted. And this includes things like lack of clarity around the rules for jointly owned properties, lack of available software, and the limited number of taxpayers participating in the trial. As of today, we only have confirmation that there are 97 trial participants. A meeting which was arranged by me was also held with the other professional bodies at the end of August to discuss a joint approach to government to express our concerns on making tax digital and tax complexity. That was followed by a meeting with HMRC's policy team on the 31st of August to discuss our concerns ahead of the new Prime Minister Liz Truss being announced the following week. At that meeting with HMRC in August, the Institute and other professional bodies really put forward the views and reiterated the need for HMRC to take stock of the very challenging timetable for making tax digital for income tax and revise this to enable HMRC to reconsult. Businesses, taxpayers and HMRC alike would benefit from this additional time to prepare and the opportunity for further collaboration. The key message given was that HMRC should focus on delivering objectives well rather than overstretching capacity. we'll continue this joint work with the other professional bodies on these particular areas. Just to highlight even more pressing, making tax digital for VAT and the closure of the online VAT portal from the 1st of November 2022 is a real concern. We've highlighted that this could impact on the Exchequer if businesses are not signed up to making tax digital for VAT on time and are unable to pay the VAT due because they can't file VAT returns. So overall, the professional bodies are clear that further digitalisation of the UK tax system is only possible if delivered and implemented in a way that it allows businesses, taxpayers and HMRC sufficient time to prepare. We've also put forward very strong views that the UK government needs to deliver certainty and stability for businesses during the current cost of living and energy crisis.
And
finally, just to stress, this recording just gives a flavour of key work streams. I would encourage you to keep up to date with all the latest UK, Irish and international developments through Chartered Accountants Tax newsletter, and that issues every Monday. So of course, if you've got any questions, please do get in touch via the email addresses on the screen. And finally, I've just provided you with some useful links there if you want to look at, for example, some of our work specifically on tax representations. We also have a link there to help you sign up to Chartered Accountants Tax News. So thanks very much for listening, and I look forward to the next update in December. Thank you.
A big thank you to Leontia for that very great, the great overview, all in 15 minutes on the budget and all her interactions with HMRC. Very busy as well in this side of the border and in the UK. And again, as Leontia says, if you have any particular questions, she's always happy to take those questions and come back to you. And that's it. Conal, as we get to the wrap up, and thank everybody who's stayed with us so far. Any further questions after coming in there, observations, anything like that before we get to the thank yous and the wrap up?
This is the Finance Bill CPD event not listed on the list of CPD events. At the Institute not involved with this anymore. Is there a Finance Bill CPD? I think there is Finance Bill CPD.
Yeah, there would be. To clarify for whoever is asked that question, I saw that one there. I list the events that we in Practice Consulting are coordinating. That would be a tax event and it would be coordinated by our CPD team. So my advice is drop a line to the CPD team, or even just go onto our website and upcoming events. And the emails. I would imagine, I'm not 100% certain like yourself, Conal, that there would be, when the finance bill is actually, and I think this year there's a little bit of a gap between, as Gerald said, between the budget brought forward and the bill coming out. When that comes, there will be an event as well. I would be virtually certain on that. So as I say, keep an eye out in the emails for that attendee there. Any other questions, Conal?
I think that's about it, Jeremy.
Brilliant, brilliant.
Oh, just one final one. Is the Isqm webinar last Wednesday available to rewatch? Yes, it is. Absolutely.
It will be. For all I know, it already has been put up as a recording. We can check with the CPD team, but it will be available very soon. And Conal, I think we will be looking at doing other webinars as well, as I say to you, because I think people love the live webinars too. So we'll be looking at doing something like that again in the next few weeks. And of course, for the monitoring and follow up into 2023, because it's an ongoing project. So rest assured that probably won't be the final webinar. But the next thing is for us to get the actual toolkit out there so you can begin to work on the process.
Absolutely, yeah, absolutely. That's great. As I say, anything else to say about that?
Well, I leave you to be looking there at any questions.
Somebody else typing an answer, so I think
we can answer.
Chris is the answer there. He probably, if Chris is the man doing it, he may well have put it up or about it himself.
He may be able to tell us, as I say to you, or definitely it's a good actual point to raise. There's so many recordings of our courses. So if you go into our CPD page on the Institute website, as well as the upcoming courses, you have the past recordings, some free, some not. I think it's about there's about 140 recordings listed there. About half of them are free, and they're updated on definitely 2 or 3 times a week by Chris and the CPD team. So if you've missed the course and you're not quite sure, go in there and check it out. Yeah. Listen, that's probably nearly us for the actual for the afternoon, and thank you for staying with us. Basically, I'd just like to thank everybody, Chris, firstly, for all his help as ever, as our technical man, keeping the show on the road. To thank everyone as well for particularly our guests. So starting with Damien and Activist and their support on this webinar, of course, to Lillian, to Dee, to Mike, and to Leontia and to Gerard. Thanks for all your contributions here. Thank as well to our team, as I say, Bernie and Practice Consulting team, and also to everybody on the marketing side and the wider CPD team for all your help. To Shannon as well for getting out the slides and for all your help, as I say there. And listen, guys, thanks for staying with us here on this webinar. A few minutes over, but not too bad when you count in the extra tax update from the UK. And listen, guys, we hope you found it useful and that you'll be along to one of our upcoming webinars, or if you're here in Belfast in this part of the world in Northern Ireland, that you can join us in person in 2 weeks' time at the Titanic. And Conal, thank you as well for all your help this morning, of course.
And yourself, Jeremy, putting it all together, as always. Right, okay. Thanks very much. Look after yourself. Take care. Cheers now.
See you now, guys.